And Ron, it is all yours.
Hey Hubert, thanks so much. Hello everybody, this is Ron Haydt at MarketTamer.com. Hope you guys are doing awesome. We've already done a mic check, so it should be working mighty fine. I do have to show and say the disclaimer. It's for the good old government, but it's also for the NSA who shouldn't be listening, right? That nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. So it's awesome to be here with today's presentation from Trade Thirsty. I really appreciate Hubert and Jeanette and everybody bringing me in. I see some friendly faces already. Some of you guys may know me, you may not. I've been trading since 2000. Got into the market, didn't know a darn thing about anything, from the farm country of Pennsylvania, if you will. I have no background in finance other than I could count potatoes type of thing. And when I first started out learning about options, it was so complicated at times. You know, I consider myself to be pretty reasonably smart. I may not be the sharpest tool in the shed, but when I picked up these books, I was floored at how complicated some of it was, and I almost gave up. Well, actually, I literally did give up twice, and the third time was the charm. So when my business partners and I, when we found a Market Tamer, we wanted to make sure that when we present and we teach folks, especially that are new to trading, that it's a very simple way to trade, it's very easy to learn, and you don't have to feel so overwhelmed. So as we go through today's presentation, which I promise you I will be done in an hour, so I won't go over, we'll keep everything on track. I want to make it simple, and that's the approach. So we're not going to get into the Greeks. Are Greeks important? Depending what you're trading, sure. But do you have to know every single Greek to do every single thing and account for every single variable? No. No, you don't. And that's the approach we're going to use today. So in the emails that you guys received, I'm going to show you how to fix broken trades. Because no matter who you are as a trader, you're going to have something that goes wrong. I have stuff that goes wrong. I lose money too, just like everybody else. But the point is, if you're trading stocks and options, and there's a way for you to fix a trade, imagine the impact that could make at the end of your day, at the end of your year, at the end of the portfolio. So we're going to talk about that today, and like Hubert said, I'm going to keep it really simple. So I'm going to answer all your questions at the end. My goal is to get through this in about 45 to 50 minutes, and we're going to do a 10 to 15 minute Q&A. So I'm going to go pretty fast. If you have questions, go ahead, write them down. I can peek at the question box as we proceed, but ideally I'd like to hold them to the end if we can. So let's go ahead and kick off. Now I'm going to have some funny slides in here. I think at least they're funny. And we're going to talk about accidents. Now accidents happen in real life, right? This is a skateboarder. I can't do that. I think I would have broke my neck. Car accidents, well, they happen too. And why you would go bullfighting, I just don't know. Maybe you just had a bad day or you needed to cash in a life insurance policy. But gentlemen, that just hurts by looking at it. I don't think even a cup would help. That's pretty bad. And I got married last year, and my wife told me that if I do any presentations from here on out, there better be a cat in it. Now as traders, man, no matter how long you've been trading, you know that stock market accidents happen too. It's impossible to avoid. So no matter how often you've traded, even if you know what you're supposed to do, every once in a while you're going to find yourself making a mistake. Or maybe you do everything perfectly, but this time the market might surprise you. And it recently happened to a stock that y'all know pretty well, and it's Facebook. Now here's the worst part. When Facebook went public, we told our members, listen, don't buy. And let me give you some background on this real quick. Apple is typically the #1 stock almost every week when we do our Market Outlook session, where we chat with our members and we take their own stock questions and say, hey, it's bullish, it's bearish, whatever. It's really cool. It's my most favorite class of the whole week. But when Facebook was coming public, everybody was just jumping in on this one, and it overtook Apple. So folks said, hey, you guys fix broken trades, you guys buy stock, and you say that you can actually fix it. And they said, well, when it comes public, we want you to go buy it. And we're like, okay, hold your horses. Facebook is not taking the company public to make y'all rich. It doesn't work that way. They're making themselves rich. When the smart guys are selling, you do not want to be buying. And we reference Blackstone. Now, have Facebook and Blackstone recovered? Sure. But look what happened to Blackstone after it went public. Yeah, it went down to like $5 a share. It was actually sub 5. These companies don't go public so everybody else can do well. That's not the idea. If it happens, so be it. They're doing it, so they do well. So when Facebook went public, everybody said, we're going to buy, right? We're like, listen, if that stock doesn't have options, again, trading it good with it, we can't effectively hedge our risk the way we trade. So no, I don't want to buy a stock, number one, until options are available. Now, when Facebook went public, the options did come out very, very quickly. So when Facebook dropped like $5 and it went to 40, folks were saying, buy, buy, buy. We're like, no. Hit 35, now the options are out and so forth. Like, no. When it got to 30, to be frank, we just got tired of listening to it. We said, all right, we're going to say uncle. We will buy because our members said, all you guys say is you can fix a broken trade. Now, you can't fix every broken trade. That would be impossible. And if anybody tells you you can, I'd run the other way. But often, a majority of them can be fixed. So we just said, fine, we'll buy it at 30. And what happened? 100% dead wrong, just like we knew, because we were on record in a recording saying we really would rather buy Facebook in the mid to low 20s. At that stage, I think we can find some value based on what we're seeing right now. And after we started the position at $30, you betcha, it dropped by a third. It was now down by over half since the IPO. And this is where Facebook was. And look what happened. It actually did drop almost down to 20. So if we just could have had the herd wait, we could have gotten an amazing price. Actually, almost near the bottom. I think we probably would have had to succumb the moment it dropped to 24 because we did say mid-20s would be good enough. But we bought at 30, and it just kept going. Now, here's the thing. Even though we were 100% dead wrong when we bought the stock, and we pretty much knew it, we were 99% sure we could turn that loser into a winner. Why? Because we've done it before. We use a very simple but very hugely powerful method that can turn a losing trade into a winner. So in this session, I'm going to share with you how you can recover from a really bad trade and turn one into a winner. Because you should know how to do this. Because you do it everywhere else. Think about it. If you have an accident, a doctor can fix you. If you have a pet, the vet can. But what happens if your portfolio is hurt in a stock market accident? How do you fix that? Well, just like a mechanic fixing a car or a pilot flying an airplane, we got to have that four-letter word. We got to have a plan. We got to have a plan to fix the portfolio, to fix the trade. Just like insurance, when things go wrong. A plan is needed because guaranteed, one of your trades at some point are going to go wrong. Think about it. Would you really let a pilot fly a plane without knowing what to do if things went wrong? Would you really go to a heart doctor who had no idea how to fix a heart? I doubt it. So why on earth would you risk something you've worked your whole life for, the nest egg, without having a plan in place to do if things go wrong? And the reason you can be sure things are going to go wrong is nobody has a crystal ball. So even though you're going to research a company using technical analysis, fundamental analysis, sometimes you're going to be wrong. And once you can admit to yourself that, you know what, I will be wrong someday, you'll be able to embrace the idea of fixing what's broke. And to do that, we got to have a trading plan. Because without a plan, we all have those two little gremlins. One says buy, one says sell. Fear and greed, right? And you're always wondering, are you getting the best price now? Should you hold it? Well, we're going to put that aside. Because if we have a plan in place from the beginning, we'll know what to do, at what time, and it'll be the right thing. Because without a plan, you're going to take losses quite regularly. But what if you could turn a losing trade into a winning trade? Think back, we're in August, think back to tax time, looking over the portfolio. We all have losses. But what if you could take some of those losses and turn them into a $1,000 winner, or just to break even? With a 10K portfolio, that's a $2,000. You're up 10% from being down 10%. These little changes where we can fix a broken trade, get it to break even or get it to profitability, would have massive effects. Could you imagine what your year would look like if you could turn those losers into winners? It would be absolutely astonishing. Think about all the extra money you would have just by not losing. And I'm not saying turn everyone into a winner. Just get them back to break even. Huge, huge, huge difference. So it's better not to lose, but how do you do it? And what do you need to fix a broken trade? We're going to talk about two key ingredients in our next example. It's going to be patience and it's going to be discipline. Why? Because if you have patience, you can sit there, wait for the event to happen, and the discipline's going to come in at, when it occurs, you act. Very, very simple. Whether it's one of these athletes, insert Michael Phelps, insert the World Cup winner, nobody got successful by just trading over a weekend. No business person got rich overnight. And while it is possible to get rich overnight in trading, you're going to have to take on a boatload of risk, and that's just not smart. So remember the saying, and it's something that we really like to adhere to. The jug fills drop by drop. And what do we mean by that is, as we go through this example, and just our trading in general, we want to do the right decision, make the right decision, at the right time. We're not trying to make 1,000,000% overnight. We just want to make the right decision today, make the right decision tomorrow. And if we pick up the nickels and the dimes along the way, by the end of the year, we're going to have a good year. And we want to think of the nest egg the same way. Little each month, by the end of the year, we're going to be in a good position. So let's jump into that trade example right now. And we're going to literally show you a trade, well, we will show you a trade that literally went wrong the very next day. In fact, we'll show you how to turn the loser into a winner. And here's what's key. We like to trade stocks that have symmetry, not stocks that are like a Mexican jumping bean and they're all over the place. We want stocks that actually do trend. I'm going to give you a plan that's going to be very clear, easy, repeatable, and it'll be step by step. And when you find stocks that do have a tendency to trend, that have some symmetry, it's a boatload of fun. So let's talk about how to fix a broken trade the market tamer way. Now I've purposely removed the stock symbol from this chart. So this is the daily chart. Each candle represents a single day in the market. Don't worry, I'm not going to get too in-depth here, but if you're wondering, because I'm sure some of you guys are, there's a blue and a red line. I promised you this would be simple. So the blue is the 5-day EMA. The red is the 20-day EMA. That's it. And we're using candlesticks. Now, if you notice over on the right-hand side, there's a white circle, and there's a little grayish-white candle in there. Now, when you look at this from a daily chart perspective, the stock came down and actually hit that gray line. It bounced, and it's starting to make higher highs and higher lows. Looks like it's moving higher, right? So we're going to establish a position. We're going to buy it at 72. Look what happened. Look at that white circle. Remember that little white grayish candle? It's like, are you kidding me? We bought the stock that day. And this was the hilarious part because as a trader, you often end up buying the top, right? Inevitably. So we were tracking this for our members on record. And that's exactly what we did. We literally bought the high, 72 bucks. And now it's at 68. So the folks are actually laughing. And they're like, haha, this actually happens to you too. I'm like, all the time. You can never be perfect. So this was a great learning experience. Now, here's the deal. The blue line is crossing down through the red. That is what we call a sell signal. It's a very simplistic approach. There's all kinds of other cool stuff we could use, but I see there's a ton of folks that are just joining now still. So just keep in mind, this is a very simple approach. Very simple. When we get the blue through the red, it is a sell signal, period. So at that stage, we have this stock. Instead of just dumping it and taking a loss, we're going to buy a long put to protect our share value. We're going to buy it at strike 70, right near where the stock is trading. And we're going to pay about $5 per share. And we'll buy about 3 months in time. Now I want to pause. If you're trading futures, Forex, using a stop is awesome. Stop yourself out before it gets worse. And that's okay. I have no problem with that. I trade some futures. I use it too. Now, if you're day trading stock, could you use a stop loss? Sure, you're day trading stock. That's no problem either. Stop losses are cool. They're very effective. But what I want to focus on is the topic that's probably going to hit the most amount of traders. And I'm going to assume that a lot of us have IRAs, 401ks. We're probably closer to retirement than not. So you have some money in the market. And you went out there and you bought a stock. And that stock you bought, I hope you bought it because it had good fundamentals. Maybe it even pays a nice dividend. And you expect the stock to move up over time. Well, those 3 reasons are typically why you would buy a stock. It's going to go up, maybe it pays a dividend, and you've done the homework, good fundamentals. But even stocks that have great fundamentals trend down. Berkshire Hathaway has pullbacks. Apple has pullbacks. IBM has pullbacks. No matter what the company is, they have pullbacks. So why would you want to stand there knowing up front that you're going to own this stock for a long period of time, and yet you're going to freak out when it starts trending lower? And then you're going to hope it's going to go higher. Where what we want to do is, hey, if it gives us a sell signal, why not ride that little turkey lower? Why not try to make some money off of it? Because the more the stock moves up and down, the more opportunity it can actually give us to make more money. And that's what I want to show you. So if you're looking at this right now saying, geez, if the stock went down, I would just get stopped out. That's not what this is about. These are about longer-term positions, so you don't have to be freaking out when the market does correct. Well, like it is now. All right, so now that that's been put in there, we have our sell signal. We're going to buy a put. We're now protected. So what does the risk look like? Well, we bought the stock at $72. We're going to buy strike 70 long puts. We're going to pay $5 per share. So our risk, meaning if the stock went to 0, is only $7. Because keep in mind, if we have long puts protecting our stock, we always have the right to sell our stock at 70. Well, if that stock goes to 0, we can sell it at 70. We're out $7. We're out the price we paid for the put or the insurance policy, and we're also going to be out the difference between where we bought the stock and the long put strike price. Now in this chart, I'm going to be asking you guys a question. Go ahead and commit to an answer when I ask you. It'll be fun. Where the red arrow is where we bought the put. The put's going to increase in value. It's the insurance policy as the stock drops. Over on the right-hand corner, the stock's right around $60 a share now. So the stock's actually dropped about $8, $10. If you look at the left circle, there's a previous support level there. This could be called a double bottom. So the stock went from 72 to 60-ish. The long put is now very profitable. Here's my question to you. Should the long put be closed? What do you think? Go ahead and commit to an answer. Oh, this is going to be interesting. Ooh, it's becoming one-sided. Oh, here come the no's. All right, it's neck and neck. All right, first of all, thank you for committing. Second, there's no wrong answer. They're both right answers. Oh, some of you guys are even giving more advanced commentary. I appreciate that. Very, very interesting. Here's the deal. If you decided to bank profits from the long put position, meaning you sold to close the long put, you just found out that you're more aggressive by nature. If you decided to hold those long puts, those of you that said, no, keep it, let's hold it, you just discovered you're more conservative. Here's how I like to rationalize this. If you're closer to retirement or in retirement, you probably said the word no to selling it, meaning you kept it because you got to protect that nest egg. If you said, yes, let's sell that put and cash in the profit, you're probably a much more aggressive trader. You're probably younger as well. Or the money that you're trading, you're more comfortable risking. That's all. That's why I said there was no wrong answer. You both were right. It's just what kind of trader are you? And what kind of money, what pile of money are you trading? Does that make sense? Now here's one key point. The 5-day in blue never did cross down below. I'm sorry, the 5-day in blue never did cross up through the red. Hence, no bullish crossover occurred. So technically speaking, we're still bearish. And look what happened. The bottom dropped out. The stock went down about another $10. So the conservative traders, all you folks that said, no, let's keep the put, you were vindicated. You were proven more right. Remember, you both were right. But being conservative actually paid off tremendously. Now the long put is just rolling in profit. But now we have another issue. With earnings imminent, and it's the big E word, it's the one word that can really screw up your portfolio if you're not prepared for it, especially a long-term portfolio. With the stock now at $50, we got a problem, or a dilemma. We don't want to hold strike 70 long puts. Why? Because they are just loaded with profit. It's sort of like it's like an apple tree loaded with apples, you know, it's just right for the picking. And the storm clouds are coming. But I also don't want to hold that long put through earnings, because if this fundamentally sound stock that we're holding that just happened to have a little correction, if it actually has a great report and the stock jumps up, all those puts are going to be gone. And I was reading your comments that you guys were typing. I can see there's a lot of seasoned options traders in here, because you guys were saying, roll that long put down, move it down, don't give up those profits, because you've been there, done that. There's lots of us in here today that I bet have bought a long put, watched the stock go down, we're looking at all this great profit, and then the stock gaps up and all our profit's gone. So we do not want to let that happen here. However, going into the second bullet point, we don't want to go through earnings without a long put, because what if there's something to this? What if this little downtrend in our fundamentally sound stock is because someone knows there's accounting irregularities and it drops 30%? Right? So here's what we're going to do. What some of you guys were actually saying earlier was spot on. We're going to roll. What does that mean? What we're going to do is sell to close the strike 70 long puts and bank some serious profit. And we'll simultaneously buy to open a new set of long puts right where the stock is trading, right at 50. So if you're simultaneously closing one and then buying to open another, they just call it rolling. So here's what happened to our long put. We paid $5. We sold it for 20. We made 15 bucks. Now I understand the stock's down like 20 bucks. But for a lot of people, they just would have lost that 20. We made 15 of the 20. That's pretty cool. Now to buy that new long put, we're going to pay $3 a share. That will increase our cost basis. So what's our new cost basis? Take $72, the original price we paid for the stock, subtract off 15, profit from the long put, and then add 3 for the new long put. So we have an adjusted cost basis now of 60. I get it. You bought it at 72. But 60 beats the crap out of having a cost basis of 72, doesn't it? Remember, we're going to keep this simple. We're not getting really advanced here. Then look what happened. The stock did gap up. Boom. And it stayed up. So the earnings report turned out to be great. Now, why did the stock trend down? Well, your guess is as good as mine. Money moves around the market. There's seasonality in almost every sector. There's hot money. Sometimes it's running into energy, and then it's running into gold, and then it's running into durables, and then it's running into healthcare. It sloshes around. Maybe the company got a downgrade, or maybe the company didn't announce their new product on time. So there was just some profit taking and people wanted to go find the next high flyer, whatever it might be. But if the fundamentals really haven't changed, let's just hold the stock. So it gaps up. We've cashed in our long put for huge profits at the bottom. And if we wouldn't have, we would have given back over half the profits. So this is precisely what we wanted to do and what we were hoping to have occur. Now look at it. Holy mackerel. It gapped up, rips up, pulls back, goes right back to 72. Even though the stock did pull back a little bit there on the right-hand part of the screen, no sell signal ever occurred. The blue never crossed down through the red. Whew. We're back to where we started. And by the way, the time frame from where we bought on the left to where we are now on the chart on the right is almost 5 months. 4 months, 4.5 months. So now you're back to break even. And I bet the folks that didn't understand how to use a long put to their advantage are probably saying, "Whoo, doggy, thank goodness we got our money back." Whereas us option traders, we're sitting pretty. Because if you did a buy and hold and you didn't do a dang thing, you suffered greater stress during the downtrend. In fact, let me back up. How many of us, and just be honest, bought the stock on the left white circle at 72, saw the stock go down to 50, and now you're thinking, oh man, I'm down like a third. What if this company has a really bad report? I don't want to lose another third of my money. This just didn't work out. I'm just going to close it before earnings because, gosh, it could get a whole lot worse. At least I have other money to go put towards something now. Who would have done that? Or better yet, who has done that? I would raise my hand before I understood what options were. Who would have just bailed before earnings? And not only that, who would have been kicking themselves in the behind all the way down saying, I'm the worst trader in the world. I'm a blank, you know? Why does this always happen to me? I think we've all been there at some point as a trader. But because we used the long put, we actually slept like a baby every night. And that was the point. So, if we were a buy and holder, we had tremendous amount of stress. We probably lost more hair, which I can't afford to lose. Maybe we would have stopped ourselves out. But by using the married put strategy, we actually made 12 bucks a share. Net. Because the second long put we bought is basically worthless. So I know we made $15 from the first long put, but then we lost 3 on the second for earnings. So net, we're still up $12 a share. So with that stock going from 72 down to 50, back to 72, on 500 shares you made $6,000. On 100 shares you made $1,200. So this is serious. The risk was always predefined. Now look what happened to the stock. Now it's up at 90. So with the stock at 90, our return on risk is over 50% in 7 months. All on a fundamentally sound stock that you believe has a good future. It may or may not pay a dividend. I'm not talking about buying some kind of high flyer drug stock that might make a drug one day type of thing. It was a real company, and I'm purposely not telling you because it's going to skew your bias, and I don't want to do that. So in this example, we only looked at employing the long put option. I know some of you out there are thinking, couldn't we have used call options? The answer is absolutely. And I'm also going to show you a how do I call it? I always look for a good word, a non-sexy way of doing it, a non-pretty. We're not putting like the prettiest lipstick on the prettiest little piggy type of thing, you know, that saying, or I'm not giving you the best example possible. I'm trying to keep it low-key, you know. So if we get that sell signal back when we first bought the stock at $72, for example, we could go 3 to 4 months out, sell calls on the stock. We're going to sell 1 short call for every 100 shares, and we're going to take in about $3 a share. So when we take in that $3 a share, that's our money to keep forever. Nobody can take it from us. But we do have an obligation now to sell the stock at that strike price of 70. Well, we know from a previous chart that the stock did trend lower, and in fact now it's down at 50. So we have earnings coming up, remember? Now, if the short call is way, way, way out of the money, far away from where the stock is trading, you technically could just let it there and not even pay a few pennies to buy it back. But in our example, we're going to keep it simple. We're going to buy it back. Why? If we remove that short call, we can go back to having infinity as our reward potential on the upside. As long as that short call is there, technically, even if the stock goes from 50 to 70, now we can't make any more money. So that's what we're going to do. We're going to buy back the short call, pay a penny, 2 penny, 3 penny, maybe a nickel, and just get rid of it. So when we go into earnings, we're only going to have stock with unlimited upside and a long put just in case something really bad happens. And then, as we know from the previous chart, the stock rips higher, goes up, and there's no short call to stop us because, what do you know, the stock actually did go from like 55 right up to 70 pretty quickly. So here's some very simple rules of thumb. When a stock is in a downtrend, we want to sell calls against the stock. Why? Well, if it's in a downtrend, what does that mean? Downtrends mean lower highs, lower lows. So you sell calls. It's, quote, free money. And if technical levels fail, if support levels are broken, what does that mean? Well, previous levels where a stock bounced. It's not bouncing. It's going down. Boom, let's sell more calls. Let's keep putting money in our pocket. And then prior to earnings, we want to buy back those short calls as a rule of thumb so our upside remains unlimited. Now, if we account for selling that one short call at $3 a share, we're now up $15 a share, or $7,500 on 500 shares. Now our cost basis is even lower. Now it's down to 57. And that's huge. And actually, let me stay on this screen. Here's the other thing. I want to ask you a question. Let me back up. During that stock's downtrend, what else could we have done? Remember, I only told you we bought one long put for every 100 shares, and I told you we only sold one short call one time. What else could we have done if the stock was dropping precipitously? Couldn't we have gone to weekly short calls? Does anybody here trade weekly options? Could you imagine the premium that you could be collecting on a week-to-week basis? We only went out 3 to 4 months and took in $3. You might be able to take in $1 a week. Well, this stock was dropping for 2 months. Holy mackerel. Figure that one out, right? So I want to be clear that I didn't use the bestest example to make this look good. We only used one short call, and geez, we took in a lousy $3. The other thing we could have done is you could have added extra long puts if you wanted to. That would be much more aggressive. So the key here is we only did 2 adjustments. We bought a put and we sold a short call. That's it. Nothing over the top, nothing to make this look better than what it is. So it's pretty straightforward. So now you know how to fix a broken trade, a broken stock trade, even one that goes entirely against your expectations. Now, I also promised you that we would do a spread trade too. So I'm going to start to speed up. I'm going to keep aware of the time here. I see some friendly faces like Keshav and some other folks here as well. And you guys know we have an algorithm. And we're very proud of the algorithm. We've actually developed a second algorithm, which is the 2.0, which is strictly credit trade based, which is doing unbelievably well. So I thought, you know what, when we do these presentations, why not take something we created that we're proud of and then actually say, yeah, it didn't work, but we can still fix it. So the algorithm picked out Boeing, as you can see from the chart here, and the green arrow is the entry, and it triggered bullish. So the stock actually broke out, and the algorithm said, hey, there's an opportunity here to go long stock, long calls, or do a bull put. And we love credit spreads. If you trade options a lot, you learn that selling time is pretty gosh darn awesome. That's what a lot of professional option traders will do. So if you just bought a long call here, you're doing really, really well. In fact, you're out of the trade already after about 4 or 5 days. But if we did a bull put spread, you have to stay in and let time actually erode. So that horizontal white line is the short put. So we did a 125, 130 July bull put, and we took in 70 cents a share. All we need is the stock to stay above that white horizontal line. And it actually just did fine. So we're at a key swing low from the middle of May. Everything looks great. Look what happens. Gap down. Look at the volume. The big spike, the red line there, the lower white arrow. Huge volume spike. Folks, this is a trend change. It doesn't get much clearer than this. So we have a bull put spread. The dotted line's the short put. It's encroaching on the short put. It's not there yet, but holy mackerel, that kind of volume, almost, it's over, I think it's about double what the average volume is, triple almost. This is institutions. This is not you and me selling. So the stock is crashing. We now know we have a problem. We have to invoke the contingency exit plan. Now, we have these plans in place before we do the trade. So if something really crazy happens, we're not going to be caught off guard. Now, what's vital when you're trading, and I just said it, you got to have a plan in place before the trade goes wrong. You can't go, I don't even care if you're trading Forex futures, bonds, whatever you're doing. You're trading cocoa. You got to have a stop. You got to have an adjustment strategy. You got to have something. And as long as we do that, we won't be the deer in the headlights. We'll be able to act appropriately instead of reacting and freaking out later. So here's what happened. We're going to focus on the purple writing. The yellow circle indicates the gap down. The purple says, due to the trend change, we're going to close the bull put immediately. I know it's not in jeopardy yet, but gosh, we have a trend change. We're not going to be silly here. We're going to close that bull put spread, and we're going to add a bear call spread. So we're going to go from being a bull, which the stock actually was going up, and the long call people made good money. Now we're going to be a bear. We're just going to react to what happened. We see what happened, we now act. So we've adjusted according to our contingency exit plan, but where does that leave our overall trade? We'll focus on the box at the very bottom. When we first did the trade, we took in 70 cents credit. So imagine taking that money and putting it in your front left pocket. We then had to buy to close that trade and pay 80 cents to do so. You pulled 80 cents out of your pocket. This sort of sounds like the government. We have an IOU in our pocket for 10 cents. But the new bear call put 69 cents back in our pocket. So now we're back up 59 cents a share. That's what we can make now. The stock actually dropped again the second day, and then it put in a doji festival, 5 straight dojis. And we're getting to see some tails on them. And if you're a candlestick person, you're probably thinking, wow, this could be a pause in the trend. We might be risking a reversal here without getting too granular. So what do? We close the trade. Really? Yep. Gang, here's the deal. We first started this trade at the end of May, which is Memorial Day here in the U.S. We went out to July. It was a 51-day trade. We were targeting about a 16% return. About 2 weeks into the trade, the stock gaps down, major trend change. We close that bull put in July. We then add a bear call, not in July, but using June week 4 options. So we actually go from expecting 16% in 51 days to going to a much shorter trade, a 3-week shorter trade, and make 7.9%. It's like, let me get this straight. We started out going for 51 days. We were wrong. We actually moved it into 22 days, and we made 7%. It's like, exactly. Because we have weekly options at our disposal, sometimes we can actually shorten a trade even when it goes wrong, and still have an opportunity to make money. That's pretty cool. And was it some kind of special sauce? No. It was just having a plan in place. We see a trend change occur. We're not going to stand by and take it. We're going to adjust. And because options naturally decay over time, we're doing what professionals do. We're selling that time. We're collecting the premium. It's a very powerful way to trade. So I'm going to keep going here. Beyond this simple and yet very powerful strategy that I just showed you, there's other trades that we can adjust, that we can fix, whether they're collar trades, ratio, back spreads, calendars. I'm a fan of diagonals. I'm a fan of even going deep in the money as stock surrogate trades, because you look at Netflix or Priceline, some of these stocks are quite expensive. And if you go in the money and buy some calls, you can control those shares at a fraction of the price. Even those trades can be treated in a similar fashion like we did with the stock trade. Now, you don't have to master them all, but you do want to start with one. Pick that one strategy that you like. Maybe you're new to options. Maybe that one is just learning about a long put. Or maybe you have options knowledge already, and you want to learn about these credit spreads that the professional traders use to consistently generate income. It's what we use. Well, we can teach you that too. So I am going to do Q&A. I think our time's going pretty good. We have about 15 minutes left. Here's what I'm going to do for you guys. I will answer every question. This is the best offer we have ever had, actually, and we're doing it over the summer. We're going to, for $7, I'm going to give you guys an opportunity to see what we do, to look at our videos, to go over exactly what we did, and give you an opportunity to learn more about it. Because I know some of you guys might be hearing me for the first time. You don't know me from Tom, Dick, or Harry. And other of you guys know that, hey, you've heard Ron before, and you're going to know that this is our best offer. So I'm going to give you access to our live coaching program. So over the course of 14 days, for that $7, 50 cents a day, we'll talk about how to hedge risk and increase profit potential, just like we talked about today. We'll talk about what strategies are working right now, how to fix broken trades, how even though the market is correcting and we're sort of exiting earnings season, but there are some companies that are still reporting, how you can sleep at night no matter what the market does. You should be able to profit no matter what the market is doing. That doesn't mean you have to be in the market every day, but if the market decides to chop around, let it chop around. We'll have an opportunity to make some money. And we'll also talk about how to do weekly options. So here's what you're going to get access to. We have 3 live coaching calls a week on a Monday, Tuesday, and a Wednesday. On Mondays, you're going to get access to me. And I talk about what to watch for in the week ahead. We'll talk about equities, the Russell, the Dow, the NASDAQ, the S&P, bonds, oil. We'll talk about gold and silver. I'll talk about what key support and resistance points to watch for. And what I do in that 1-hour session is the first 20, 30 minutes we talk about the market, and the last 30 minutes, it's all you. You give me one stock that you're watching on a per-person basis, and to steal a line out of Kramer's book is we're going to do it lightning round style, where I blow through them in about 20, 30 seconds, each one of your stocks. So we literally can cover about 30 to 60 stocks in a half an hour. It's super fast, real fast. And then if we actually see trading opportunities, we'll stop and then talk about, oh my gosh, I'll use Keshav, for example. He might bring in Apple. We'll go after Apple. And we'll say, hey, this actually chart is setting up beautifully. There's a trading opportunity. So you'll get to learn support, resistance, trading opportunities in that session. Now, on Tuesdays and Wednesdays, these are 2 gentlemen that I've actually personally trained, and they've also learned on their own as well. They're going to have their classes on Tuesday and Wednesday at 9 o'clock. But please don't worry if you can't attend live. We have a ton of folks from Europe. They watch the recordings, and when they have questions, they actually email us. So you never have to feel that you're missing something. All sessions are recorded. We can teach you how to do weekly options, which is one of Dave's specialties. He actually has a live trading room. And if you want to learn candlesticks, he's a candlestick master. He's been trained by the best, and he's also learned even more on his own too. So no matter what it is, what credit spreads are working now, etc., we cover that. So for those 14 days, you're getting 3 live sessions. Now, one thing I didn't mention, which I probably should have, is we're going to do 2 bonuses. So you're going to get access to our entire educational suite. If you're coming in saying, wow, this sounded really interesting, I've never heard Ron before, and maybe I'm new to options. Well, you know what? We'll teach you how to learn options on a basic level. We'll teach you what is an option. We'll talk about fundamental and technical analysis. We'll teach you guys some what we call safe stock market strategies, ones that don't carry a ton of risk. We'll talk about weekly options. We'll talk about rock-solid income trades, the credit spreads. If you want to trade for earnings using options, we can teach you that too. We'll talk about portfolio management, and most importantly, I think, how to adjust trades, because we all know we're going to have option trades that go wrong. The second bonus, and something I alluded to a little earlier, when we sell our market timer algorithm, we sell it for $2,000 a year, period, because it's worth it. But with the summer being here, we know that a lot of folks may not have heard of us, and to drop $2,000 just because we say it works and we have testimonials, that's a lot of money. So what we're doing is we're basically making this an insane offer for the summer. We're going to give you guys also, as part of this $7 trial for 14 days, access to our algorithm on Mondays. You're going to get 1 pick each week. I'm going to go through a couple examples here super fast. You're now going to get a 4th coaching call. Gang, you're going to get 8 coaching calls over 2 weeks. I'm actually going to show you how to use the algorithm. If you're wondering what kind of stocks does the algorithm produce, these are Monday trades. Here's a Chevron bull put. If you would have bought Chevron when the algorithm signaled bullish and just went long a stock or just went long a long call, you probably would have got stopped out. With a bull put, 17% in 4 days using a credit spread. How about trading higher beta stocks? LinkedIn, within hours of entry, 97%. How about Philip Morris? A couple days, 26%, just using a long call. And you can trade long stock. You can do long stock. You can do long calls. You can do bull puts. We prefer the credit spreads. Here's Autodesk. How about MasterCard? The day it triggered, it actually finished up. It never closed above the 5-day. It then crashes lower. So is 21% in a day good? I think so. How about last week? Harley Davidson. Now, when I built this presentation this past week, there was a 20% gain in HOG within hours. By the end of the day, it was at 31%. It hit the Bollinger Band. So some folks took money off the table. As of Thursday night, it was up 140%. And then Friday, the market bounced. So it actually got far better than what you see here. How about Procter & Gamble? Triggered bullish August 5th, August 6th, it's a double. When we have doubles in a short period of time, we love to just close the trade. At the bare minimum, especially if you're new to options trading, close half the trade. At least then it's a free trade, and the remaining half you can be a piggy and go wee all the way to the bank and try to go for a monster. But when you get doubles, you just got to lock it up. So, gang, here's the deal. You're going to get 4 coaching calls each week. That means 8 for $7. 8 hours of live teaching. You're paying less, what is that, 50 cents for an hour? You're going to get access to our 40 on-demand videos, which we sell for $1,000 a year alone, and you're going to get the Market Timer Select for these 2 weeks. If you go through the 14 days and you're happy, you do nothing at all, and we're going to rebill you at $395 per quarter. So we're not pigeonholing you into a whole year or even into 6 months. All you got to do is email me, and my email address is cs, I'll type it in. My email is cs@markettamer.com. All you have to do is send me an email within those 14 days, even on day 14, and say, Ron, thank you so much. It's just not for me. Just tell me why. I just love feedback. And we say, hey, thank you. We appreciate you giving us a try. No harm, no foul. You're done. We will not bill you. If you don't cancel in 14 days, we will bill you. We don't give any prorated refunds. So if you're going to ask that, you already know. Just give us a shot. It's basically free. I don't know how to make it cheaper, other than saying that if we did make it free, then it would really be free. Now, there is one catch. You might say, what is that? We're doing only 30 people. I got to regulate how many folks come into the program because we actually do care about customer service. I don't know, Hubert is huge on that too. It's very important to us. So I know we're over, I think, 400 people right now, maybe even higher. I can't take 400 people. So I know there's more speakers coming on. They're going to have awesome content as well. But when we hit these 30, the page will actually go to sold out. So you're going to get the 14 days for $7, 8 coaching calls over the 2 weeks. You're going to get 2 picks over the 2 weeks and access to the 40 on-demand videos. You will still get everything that you see here during your quarterly membership. So if you go to our website right now and you just try to buy the videos by themselves, because let's say you just want to learn, you're paying $1,000. The education for a year, the first bullet point, is $1,500. So when you start doing the math, it's like, oh my gosh, this is by far a great deal. So what I want to do now is, I'm just watching the clock. We got about 9 minutes for questions and answers. So I'm just going to move my little box up here. All you got to do is go to markettamer.com/thirsty, okay? And you do that, and you will get this deal. Sound good? So let me start answering questions, all right? All right. Actually, I'm going to move that into the upper left. Hopefully it doesn't show up on your screen. Here we go. All right. How much to follow the program? Hey there, Henry. How you doing? Henry, it's $7 for 14 days. Go to markettamer.com/thirsty. And then it's $395 per quarter. So if you take $395 and divide it by 3 months, it's $131.66 a month. But we do it on a quarterly basis. So you don't have to worry about 6 months or a year. You know, it's only a quarterly basis. Hey there, Judy. How you doing? Judy, my email is CS, which stands for customer service, @markettamer.com. Hey there, Nick. Nick says, I am new to options. Well, it's very nice to have you. I was new to options too at one point. Does your program teach the very beginning so I can understand and actually start trading? Yes. What's very important is whether you're new and you're saying, what is an option? Which, I don't know if I said this in the beginning, but when I first started learning about options, guys, I never went to college. I never had a class on finance, although I can count money, okay? I was a farm country of Pennsylvania, all right? I had no idea what I was doing. How I got into the market was my father put a little money in, the broker lost his money, which we knew was a risk, and the broker said to my father, unless you put another $5 grand in the account, I'm not talking to you. And he hung up on my dad. That was the point when I said, pardon my French, screw you, I'm going to figure this out. And that's actually what set me on. If I wouldn't have had lunch with my dad that day and saw my dad's face when that broker hung up on him, I probably would never be in the market. So I came from as far away as you could in the stock market. And when I began learning about it, it was all so difficult. It just blew my mind. Like, this really can't be this. It almost sounded like they were making it so hard to make themselves sound smart. You know, to make you sound dumb because you don't understand. So when I say that our videos are very basic, they are. However, when you progress up through modules 1 through 4, and then you can get into modules 4 through 6, there's an increase. So you could say that I know what options are, but I don't know what spreads are. Well, then you're going to go in the middle. And if you say you have knowledge of all that, but you want to learn how to adjust, then you can target the end. You sort of see what I mean? So my answer to you, Nick, is absolutely. Hey there, W. When will the 2 weeks start? Day 1 starts today, Saturday morning. So you're going to have instant access to over 600 recorded coaching calls, 40 on-demand videos, and Monday I'm going to see you at 7 and 9 Eastern. And Tuesday and Wednesday you're going to have John and Dave. All right. So the site is working. They're telling me. So it's markettamer.com/thirsty. All right. Okay, there's so many questions here. My screen is moving. Just bear with me. Henry, I answer your question. Law. How much is the basic? Law. What we're doing is $7 for 14 days, and then it rebills quarterly at $3.95. All you got to do is send us an email on day 14 or sooner and just say cancel. We will not charge you. Once we charge you, you will be in at $3.95 a quarter. So I tell everybody now, so if the charge appears, you know what's going to happen. Hey there, Earl. How will it work on a small account? Earl, I'm not allowed to tell you how much money you need to trade options. The government won't allow me. So what I can tell you is my personal opinion. I think $5,000 is the minimum, with $10,000 being more easier to trade, in my humble opinion. Because even though you can't necessarily buy stock, we can buy in-the-money call options and use it as a stock surrogate trade. All right. Hey there, Biswa. How you doing? Unfortunately, Biswa, I can't, because we're going to sell out today with just so many people here. Larry. Okay, Larry, that's great. BC, Dave's chat room is the live trading room with weekly options. That's a totally different product. That's not what this is here today. What you're getting here today is the live coaching is $1,500 a year. The videos are $1,000 a year, and the select is $500 a year. So do that math. 1,500 plus 1,000 is 2,500 plus 500. That's $3,000. So even if you stayed with us on a quarterly basis for a year, you're only at $1,580. So it's about half price. And I would have no credibility if when I tell you this is the best price, if it wasn't the best price. So I would look pretty silly. So this is the lowest price. We're doing it for the summer because it's been a hit so far, and it gives people that have never heard of us a low price point to try to see if we actually deliver what we say. Hey, Mark, you can email us, and we can help you out with that. But it is also part of this package. Hey there, Tony. How you doing? Tony, I'll have to check that. BC, how soon will that's Hubert's question. All right, he'll help you with that. And are these videos downloadable? No, the videos are not downloadable. We keep them on our server because we don't want them migrating. To be real quick, Kaylee, one time we allowed that, and all of a sudden we found our videos on eBay. Someone actually stole them and tried to resell them, so we said, hey, we got to keep them on our server. I know, people are funny, right? It only takes one. All right. So, gang, I want to respect the time because Hubert and Jeanette have a fantastic lineup of presenters today, and you guys are going to learn some really cool stuff. I want to thank you guys for being here. The offer's good, and it will be 14 days, $7, and when it goes to sold out, it'll be gone. My email is cs@markettamer.com. You guys are very kind, very polite, and you ask great questions, so that made my life really easy. So without, I won't go on any further. Hubert, thank you so much. Jeanette, you too, and I look forward to seeing you guys next time. Have an awesome Saturday.
Thank you, Ron. Thank you very much. All right, guys, so the link for Ron's offer is markettamer.com/thirsty, just like Thirsty Trade or Trade Thirsty, right? So I'm going to put it in the chat box so you can click on it there. I've already checked it and clicked it, and it works for me, so it should work for you also. So there is the link. We'll send it to everybody again. All right.